Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the cash flow memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
Let's start on 5 minutes on Exhibit A, B, and C. The situation between Iran and U.S. is unsettled. It looks settled. From last Wednesday on, the Iran stopped shooting missiles and drones at tankers, and the U.S. stopped responding with missiles and bombs and whatnot. Things kind of started to unravel today or yesterday at East time. So now we'll have to see it. Apparently it was initiated by the Iranians. There's really three alternatives to the U.S. One is to do troops on the ground, which I think is not going to happen. Another is to maintain the embargo and do more extensive infrastructure bombing, but I think the Iranians would respond there by putting missiles and drones into tanker loading facilities and more damage to the Qatar LNG facilities, and that doesn't seem to be workable. So I think the only option for the United States is to pull back. A fair question is, should the U.S. and Trump administration have started this? Probably, with the benefit of hindsight, the answer is no, but I'm not sure that was over the longer term a viable answer, because I think this is just something that had to be dealt with. Can the U.S. on some schedule get enough anti-drone or anti-missile capacity together to be able to handle the situation? I don't think so. In terms of security of oil supply, the 20 million barrels a day or so, the industry has proved pretty good at doing that, utilizing pipes and moving enough oil so that oil stays in that 80-90 range, not the 120, 30, 40, 50 range. I personally think, from an investment point of view, that 80-90 range will be maintained. I don't think the disaster scenario with very high oil prices has got I think it's very low probability. All the time since this first started, late February, I must say, a little uncertain about that. I'm more uncertain about that conclusion now than I've been any time since the end of February. So we'll comment on this again 7 days from now. If we turn to Exhibit B, it's kind of an odd situation, but since most of the growth in gas supply has been, and the Permian is primarily an oil basin, 2/3 of the increase in supply in the last 5 years has come from the Permian. Higher oil prices can kind of make for lower gas pricing. And in fact, you'll see on the bottom of Exhibit B, the 27 price, the futures price, which is a price that people in the industry make decisions based on, is down under 350. And I suspect that is going to be somewhat lower. Once again, the last Thursday, the current price is 91 and the price of 27 was 74 now. In making decisions to drill wells, complete wells, and so forth, people do not pay much attention to the $90 price. They focus in on what's the 27 price. But remember, before all this started, we were $60 on our way to 50, and still with a fair amount of backwardation. So, this is going to be a stronger market for the people that go and complete oil wells. Exhibit A, we need a solution here to absolutely have to keep the deficit coming down. I believe the solution is in healthcare, but we'll see. I think from a macro point of view, we're going to talk about and continue to talk about each of these Wednesdays where we find value amongst these 100 companies or so. and healthcare is, in my mind, has a little bit of cloud over it because we need to reduce our spending somewhere. And we can't do much about interest. We certainly can't reduce our defense spending. So somehow the answer is going to come from healthcare. With that, we've been looking for value. The stock market is pretty high, and it's high. The overall value of the stock market is high relative to GDP, which is one way to think about whether equity values are high. But I believe, and I think Mike and Jason believe, that there are values out here. You'll remember a couple of Wednesdays ago, they identified the hyperscalers as a place where there was value. And I think that's borne out by what's happened. Before we started on page 20 and worked from the back forward, like Jason, the advent of open source models, open weight models, impact on hyperscalers. Why don't we spend 5 minutes on that before we hit the back of the memo, going through page by page, looking for values?
Yes. So there's been a lot of talk about there's lobbying efforts on the part of Anthropic and OpenAI about trying to set up some sort of an internal government entity that would be responsible for saying who can have what AI models. And this has been something that Dario, CEO of Anthropic, has been very positive on. Pretty much all of his employees are on that same camp. I think it kind of boils down to we are the only ones that can be trusted with this power. And then in the other camp, you have the open source community, which it's fair to say that the majority of the open source action has actually come out of China. But this would basically say the government should take a more hands-off approach and let the market come to its conclusion. In the last week, what's happened is all of the hyperscalers, and actually I think OpenAI even signed this letter now as sort of falling in line, that is requesting that we don't try to restrict the use of open weights models. Now, if you're a hyperscaler, open weights models are great because you're not paying additional margin for those models. Maybe you're going to spend some R&D effort to make that model run really well on your hardware, but you're not going to be paying a fee to Anthropic for their spend, their margin on those servers. So you look at Amazon, Alphabet, Microsoft, SpaceX, those companies have invested, and then we should include Meta in this list, that they've invested a fortune in their chips. They have this capacity. I think that it would be an unfortunate situation if we end up just having two providers of AI, or maybe three. It'd be much better if we have an open source, open weights model. Obviously, that benefits the hyperscalers the most. It probably does not benefit OpenAI and Anthropic as much. I also don't think it necessarily hurts them as much as you think. But I think the argument is basically these guys don't need additional government protections. It's a competitive market, and there's plenty of space for everyone to play.
Jason has been the Apple bear, and Apple's the one that's behaving well in the market. Their CapEx is so low. I guess the answer is that everyone's still going to have their handheld devices, and Apple, at least on the high end, dominates that market. So Apple seems to have escaped any negative consequence from having very low CapEx. Or anything else to add to that, Jason?
Yeah, well, at this point, I think they'll be okay as long as they eventually figure out a way to integrate one of these models, whether it's an open weight model or Gemini purchased from Google, if they figure out how to integrate it into Siri. But if they never complete that, transition of Siri into a useful product, and Android's going to just outpace them. And then I think that's probably why they're fighting OpenAI so much over what they believe is IP theft for a device that we don't really know any details about. So there's a danger there for them if they don't figure Siri out.
Mhm.
But they're in a better position having not spent hundreds of billions of dollars to train their own models.
Cash buys optionality. So Apple is sitting on a boatload of cash, and maybe they'll be able to deploy that well. But as of right now, it seems like they've missed the AI train, and the only reason that they are still valued where they are is because they make great hardware. I think that, if Apple were just a software company, it would have been taken down with everyone else.
Right. Yeah. But Mike, you did find that it appeared they were buying NVIDIA GPUs to run Gemini.
They are. Yep.
Rather than TPUs and rather than their own AI chips that they do produce and they put into their devices.
Yes, and it might have taken John Turnus as becoming CEO in order to get that deal done. Don't quote me on that, but there was a lot of bad blood between NVIDIA and Apple that went back long enough that Tim Cook was involved. So,
All right, let's scoot through the whole memo if we can. We have, say, almost 20 minutes left. What I thought we'd do is, for the moment, skip the healthcare companies, and we can get back to that next weekend, but just turn the pages on businesses that will benefit from all this compute that's being put in by the hyperscalers and the availability of less expensive tokens. Page 20, Uber, DoorDash, Airbnb, Five Below. All four of those businesses will benefit. They'll be able to reduce costs, have better productivity. It's just, it's going to be, I think, beneficial. Like Jason, any comment on that?
I'd push back a little bit on Uber. I think full autonomy creates a whole new class of competitors. And yes, maybe they are able to just acquire the assets, but it seems like Tesla's going to build their own cars and their own network.
And Waymo too. They did have a partnership with Waymo, but that looks to be falling apart.
Yeah.
Yep. I don't think there's any change to Airbnb. I don't think that business changes as a result of this. And Five Below, I don't see a negative change for Five Below.
I mean, for a retailer managing their inventory, all kinds of things, and a retailer don't benefit from.
This is the case of sustaining innovations. Generally, this is a sustaining innovation for most businesses. It's disruptive potentially to Uber, right? Which is why it's differentiated in how it might affect it.
Right. Page 19 is all healthcare. We'll skip that till next week, and we'll do AI and healthcare next week. Page 18 are specialized companies. I think I'll leave Nextera out because it's kind of a power company, and that's another issue with AI. But Freeport, Albemarle, and CFs are industrial businesses. I think they'll all benefit. I mean, Albemarle is lithium. I mean, any kind of mining activity. Freeport McMoRan is copper. CS is fertilizer. All these businesses will benefit.
On the copper front, there is an incredible amount of copper in each server rack. It's really quite shocking.
Yeah.
And the future kind of points towards optical interconnect. But I think that process is happening a little slower than people had hoped.
Right.
It may be the thing where copper can get optimized for a while until it gets to some sort of a physics-bounded limit before it moves to optical.
Yeah, great point. Page 17, FedEx, Nike, Lennar. Lennar is a home builder. I mean, at Nike, I guess you characterize as a retailer. FedEx, United Parcel. I mean, the IT departments in FedEx and United Parcel with enormous productivity, I would think, from AI tools.
The potential disruptor for either of those is fully automated, maybe last mile delivery, but that's still a ways out.
Yeah.
Lennar is interesting. They've done some of these like 3D printed houses. I don't know how much of that is really AI, so much as it is building big systems.
Lennar is a very well-run company. I think the problem with Lennar, and we'll come to Home Depot and Lowe's in a bit, but if interest rates stay high, this goes back to Exhibit A. If interest rates stay high, that is not good for the home building business. Page 16, the restaurant companies, plus a hotel company in Celsius. Once again, I mean, everyone's going to benefit from this in terms of productivity.
Agreed.
One thing to comment on is these businesses, restaurants, and things like that, hotels. The economy is very strong. I mean, whatever else you think about how Iran hasn't gone well and whatnot, every indication in our economy is really very strong. Page 14 are a collection of companies. I just say Personal and TransDigm are more distributors and manufacturers, cat, deer, and generator manufacturers. Cat, deer, and normally trade more or less in unison. They're focusing on agricultural and cat on construction and power, but cat is a producer of a lot of the equipment that's used as off-grid power, and it is, and also construction projects, and it is trading at a very high multiple times free cash flow. But this is a very capable company and probably trading too high, but to a certain extent, its performance merits, I think, a premium. Anything else, Mike, Jason, on that page?
I believe Deere has been doing a lot of work on autonomous farming tractors, which is kind of interesting. Yeah.
Oh, no, I mean, farmers and farm equipment is benefiting enormously from more technology. Page 13 are the public companies. I mean, JP Morgan, Morgan Stanley, Goldman Sachs, I mean, the capital markets benefit from having big IPOs like SpaceX, but everything about these businesses will benefit from AI. Interactive, same. Moody, very, very positive. I think the financial sector is now, it's still, I mean, Interactive is pretty expensive at 35 times free cash flow, and Moody's is pretty expensive, 26 times cash flow. But consider that when JP Morgan, Morgan Stanley, Goldman Sachs generate cash flow, it belongs to them. There's no real reinvestment requirement. And so they're interesting businesses from that point of view. They're kind of, as long as you meet your regulatory requirements and you don't get in trouble where you can't load your liabilities, really it's kind of an odd kind of way, a capital-light business. I ducked energy last week, and I'm just going to cover the 4 pages very quickly. First page, working backwards, is page 12. Antero EQT, Expand, Antero Midstream, and Venture Global. Venture Global being the new kid on the block in LNG. These businesses would do better with higher gas prices. And as I cover each Wednesday, with 2/3 of the growth in supply coming from the Permian and fertilizers. Page 11 is to the oil producers. They make decisions, and investment decisions on these companies ought to be based on the price out a year. But, they're not all entirely hedged, and that extra income is going to find its way into their revenue and into their cash flow. And in fact, they're trading at pretty high multiples times free cash flow. These are year-end 25 numbers. And so obviously oil's going to average a good $10 or $15 higher this year. But, you look at the EV times free cash flow, normally these things would be around 8 or 9 or 10, and they're all, in the early teens. But I think that's an impact of going from before the war, $60 on its way to $50 to right now being, I don't know, $80 on its way to the mid-70s. The midstreamers are page 10. They're not that exposed to higher prices, but activity is good. And then a number of these, especially enterprise, energy transfer, Targa, have a lot of export. And of course, with the straits down and with Asia being short all kinds of things, they'll do better. Problem with these companies, they yield pretty well, 6, 7, 8%, but they have trouble increasing their dividend beyond about 3 or 4%. So the way I think about that is if it's yielding 8%, its dividends going up 3%, it's an 11% return. And that's short of what we want to do. We want it on our own money and friends and family's money. We want to double it at least in 5 years, which is a 15% return. So these things are almost kind of like bond substitutes. Page 9 is Exxon, Chevron, Conoco, Oxy, Cheniere. Cheniere is the better established LNG company as compared to Venture Global. Once again, these companies are trading at pretty high multiples times free cash flow. But I think when people think, hey, I ought to own more oil or more energy, they tend to go into very liquid equities like Exxon and Chevron rather than doing more hard work and joining the smaller companies. So they certainly benefit from that. If things calm down in the Mideast, you'd expect to see these things trading at lower prices, multiple come down. Page 8 is the retail company. I think of Walmart kind of like the retail part of Amazon, and Mike and Jason will comment on that. Target just keeps chasing Walmart not too successfully. I've owned Lowe's forever, very, a lot, 8, 9, 10 times on that stuff, because I've owned it for a long time. I greatly admire it. Lowe's and Home Depot, or if you put them down on chart, they're very, very similar. But once again, like Lennar, if interest rates stay high and with the amount of issuance the Fed has to do on the trade, unless there's a slowdown in the economy and we get much lower short-term interest rates, I'm afraid we're stuck with what are based on recent past, fairly high mortgage rates. CarMax is a used car retailer, and Costco is one of the great investments of all time. Very well-managed company, very expensive, as you can see, 50 times free cash flow. Turn up the rest of the discussion here to Mike and Jason. And I think Walmart is competition for Amazon, the retail part of Amazon, but over to the two of you.
I think that's right. Walmart and Costco are the two best retailers before Amazon. Then with Amazon, it seems like they've basically been able to run the retail business at break even with the intent to make all their money on advertising or product placement, if you will. And that seems to be working quite well. I think it'd be very difficult for Walmart to get the same level of delivery performance that Amazon has. And Costco is one of the greatest businesses of all time, really stemming from a very simple business case or business model. And that's as they grow, they would refunnel those savings back to their customers. And they've built a model known as scale-economies-shared. So as they grow, gain more scale, they share those savings back with their customers. That's engendered a lot of goodwill between them and their customers. Is it 52 times earnings or 52 times cash flow? Is that justified? I think it'd be very difficult to start a new position in Costco today. I think if you're interested in retail, you may want to spend some time trying to find something that has a similar business model and the ability to grow.
I would say AI has already had a big impact on Walmart. They have a division called Walmart Labs. That's software, their software IT department. And, selling through Walmart.com is the same thing as through Amazon. AI is deeply involved in product promotion, placement, cross-selling, advertising products to specific users, all that. So I think it's already deeply ingrained there and will continue to remain so.
Yeah, good points, Jason.
Page 7 are the card companies. They just seem invulnerable. I mean, sooner or later, something will get them, I guess. And then there's PayPal, which Jason covered last week. Yeah, a takeover offer that, I don't know, Mike and Jason, I kind of imagine the takeover proposal will eventually prevail, mounted by private equity firms and other payments companies. But
I think PayPal is probably about as poorly run as Twitter was before the Twitter acquisition. So there's definitely an opportunity for maybe some value creation, but it's going to require pretty significant change management. And I think that's why Stripe is looking at it, because Stripe is heralded as a very well-run private payments firm. So they're probably looking at PayPal saying, well, we can probably roll that in and lop off, that $3 billion in R&D and $4 billion in SG&A probably goes much lower, and their operating costs probably would also go lower underneath Stripe ownership.
on page 6, Charter and Comcast, which used to be considered our household companies, now trade right in line with AT&T, Verizon, T-Mobile. And these are the companies that provide our signals for our cell phone. But it seems to be kind of, vital to all of us, but kind of a low return on investment, and probably going to continue that way. Like Jason, are you similarly, kind of suspicious of seeing upside in these companies?
So the big problem is competition. All of these companies, well, maybe not the mobile carriers as much, but Charter and Comcast had the benefit of running monopolies for a very long time. And now they are no longer that great of a business. And in one breath, you could say that we are going to massively increase the amount of computing that happens. And therefore, wires in the ground are more valuable now than they were in the past. I think that's true. But you also now have space-based communication. SpaceX is just in the last week, I believe, launched the first Starlink V3 satellites, which will be higher capacity and eventually performance and cost competitive with cable in the ground. So competition is not great for companies' long-term profitability, but it's great for consumers. So this is an industry where it's great to be a consumer.
And Elon teased a competitor to the mobile carriers in the Tesla earnings call last week, in that he proposed a future where every robotaxi has a Starlink satellite connection and then becomes a base station for a mobile network. And they kind of remotely position robotaxis to fill the network. It's kind of interesting. He mentioned that as an afterthought.
Yeah, it sounds like a harebrained idea, but if it comes out of his mouth, you got to take it at least somewhat seriously.
All right. Well, that's our agenda for next week. We'll cover with Jason Felt how AI can impact these healthcare companies. But I think the other thing we'll do is Tesla's down a lot. SpaceX is down a lot from its offer price, or from the price it reached after the offer. I think one of the things we'll focus on next week in terms of coming attractions is not only where AI can help in healthcare, but where, at what level, there's value in Tesla and SpaceX. So in the meantime, everyone be well and stay healthy, and we'll be here exactly 7 days from now. Thank you very much for listening. Take care.
The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the host nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to and no reliance should be placed on the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future and may or may not hold positions in the securities mentioned.